What's up everyone, it's Caddy with MoneyVest. So in today's video, I wanted to talk a little bit about the FOMC minutes that came out yesterday at 2 p.m. Eastern, and that's exactly why the markets rolled over and then of course sold off to pretty much close down. However, after hours, after the Nvidia earnings, we just rocketed back higher. We've got the NASDAQ up almost 1%. The S&P 500 also pushing higher pre-market. So we're basically recovering back up. But in this video, I wanted to break down some very, very important paragraphs and discussions in the FOMC meeting, which happened on April 30th, May 1st, and what the Federal Reserve really discussed during that meeting, and again, some of the things during the minutes as well. So hope you all enjoy this video and find it helpful. Make sure that you drop a like and subscribe to the channel if you're just joining us for the first time. And again, links to our Discord and Patreon is going to be down below. There is a 16% annual discount available until the end of this month. You can access all the members-only private videos, including all the trade alerts and trade ideas, options alerts, our MoneyVest index, the early access to our beta launch for MoneyVest.com, as well as all the private videos, tutorials, and our individual courses are going to be 50% off. Coupon code May50 expires at the end of this month as well. So first things first, I want to break down certain paragraphs on page 8 and page 9. So first things first that I wanted to go over is going to be on page 9, which FOMC members basically mentioned that participants noted disappointing readings on inflation over the first quarter and indicators pointing to a strong economic momentum, and assessed that it would take longer than previously expected or previously anticipated for them to gain greater confidence that inflation was moving sustainably down towards 2%. So a few things that, of course, they discussed: the fact that they disappointed on the readings on inflation over the last 3 months in the first quarter, indicating to strong economic growth, and also mentioning that it's going to take longer than previously anticipated for them to gain that greater confidence that inflation was moving sustainably down to 2%. So that in itself is a very, very hawkish tone. There was more hawkish tone where members agreed that they did not expect it would be appropriate to reduce the rate range until they have gained that greater confidence that inflation is moving sustainably down to 2%. So not only do they think that it's going to take longer for inflation to come down to their target, they have not gained that greater confidence, and they also agree that it would not be appropriate to cut interest rates at the moment. This is, again, as of the most recent FOMC minutes. Reading further, there's a few more things that I want to go over, which again is actually quite interesting because the market, of course, expectations are for us to continue to really see interest rate cuts, or at least one rate cut is what the market is pricing in right now. We're going to go over the CME Watch tool as well. So just very quickly, if you want to take a look, this right here is going to be the earnings interest rate expectations. So you come over to probabilities, and right now you'll notice that the first cut is expected in September of 2024, with another cut getting priced in for December of 2024. There's a lot of analysts that actually came out after this FOMC meeting minutes and basically mentioned that now they don't even see a single rate cut in 2024, considering that inflation continues to be a little bit higher than what the Fed's expecting. They're not getting the greater confidence that they need, and a lot of members are now turning a little bit more towards the hawkish side, expecting restrictive policy. And more importantly, which is actually quite interesting, I'm going to go over that after this. So many participants saw this uncertainty as coming from the possibility that high interest rates may be having a smaller effect than they did in the past, that longer run equilibrium interest rates may be higher than previously thought, or that the level of potential output may be lower than estimated. So this is actually quite an interesting scenario. And the reason I say this is because I honestly think that over the long term, and I actually want to hear from what everyone else also thinks about this. I kind of briefly touched on this in our Discord, and I mentioned that over the long term, say next 10 years, I think we may be in an environment where productivity is high, economic growth is high, and unemployment is also high. And the reason for that is artificial intelligence and automation. I think with the fact that there's a lot of layoffs that are happening, a lot of the tasks, that human-based tasks, are getting outsourced to AI and automation and robotics, I think there's a possibility that we enter into an economy where we're kind of heading into a direction where a lot of the stuff, a lot of work that's being done, whether it's just data-driven work, or whether it's manufacturing, whether it's analyst type work, where there's a lot of office work that is being outsourced to artificial intelligence and automation. There's a lot of products, a lot of services out there, a lot of solutions that are coming up. And as a result, people will either have to, of course, sit at home and they're not employed, or they'll have to upgrade their skills and really just harness the power of AI. And as a result, there is a possibility where unemployment is higher while also productivity being very, very high. So, I also do think that unemployment could completely get knocked out from the Federal Reserve's FOMC sort of monetary policy dual mandate, because interest rates are having a less impact on unemployment now, right? Because as interest rates are higher, we're not really seeing that level of unemployment increase. I think the more unemployment increase is actually going to happen if there is, again, companies going all in on AI and artificial intelligence and automation in general. So there's a possibility where even if interest rates are lower, unemployment's high, right? Even low interest rates doesn't do enough to bring unemployment lower, because companies are going to start borrowing, investing more in digital technologies and AI automation, as opposed to hiring more people. I think there is a possibility for that, something that we can discuss in the comment section. I was talking about this in our Discord as well. But again, going back to the topic here of inflation, the participants, again, see uncertainty around inflation. They feel like higher interest rates, there's a higher level of equilibrium that we need to hit in order for interest rates to actually start impacting the economy and unemployment in general. And one more thing that I want to break down that I think was very interesting was over here, is that a number of participants noted uncertainty regarding the degree of restrictiveness of current financial conditions and the associated risk that such conditions were, quote, insufficiently restrictive on aggregate demand and inflation. So for the longest time, we have heard Jerome Powell say that, monetary conditions, financial conditions are sufficiently restrictive, sufficiently tightened, right? Sufficiently, we're sufficiently restrictive. And now they're talking about that a number of participants noted that uncertainty regarding the degree of restrictiveness of current financial conditions and associated risk that such conditions were insufficiently restrictive on aggregate basis, because of one simple reason: inflation is not coming down fast enough. And they have received a lot of disappointing reports, is what they also talked about here. The disappointing readings on inflation over the first quarter, indicating for strong economic growth, and again, anticipating the lack of greater confidence that they're getting doesn't warrant a rate cut anytime soon. So maybe appropriate to not reduce the target rate until they have gained that greater confidence. And the markets, of course, rolled over. So this right here was the sell-off right at 2 p.m., 1:30 p.m., 2 p.m. S&P sold off over 67, 80 basis points, coming back down to 5,300. But the bottom line is that we're still near all-time highs. We're still pretty much at all-time highs. The market seems to care less and less about what the Federal Reserve's doing and what interest rates are doing, and more about artificial intelligence and automation and digital technologies and everything else related to NVIDIA and other companies as well. And that's exactly why there's only really been 11 to 12 days that have accounted for all the gains in the S&P 500 for this year. And almost all of those days had something to do with artificial intelligence and, of course, AI and technologies related to AI and NVIDIA and some of the other semiconductor companies. So markets definitely are caring less and less about FOMC and the Federal Reserve and what they're talking about. But there's a few more things that I want to go over. So Ed Yardeni came out with a very strong, again, prediction here for 2030. So Dow Jones expected to get up to as high as 60,000 and 50% increase. That's about a 7% compounded annual growth rate. And this is the roaring 20s bull thesis from Ed Yardeni. And really what he's talking about is that the earnings per share for the S&P 500 is going to hit over $400 by 2030. I think it might be $500 if I'm not mistaken here. So let's just take a quick look. So $400 by 2030 is what they're suggesting. So these estimates suggest that $400 by 2030 is quite possible. And over here, he is talking about a recent note of the roaring 20s. And Yardeni says his target of 2030 are based on continued earnings growth and a simple 6% compounded annual growth rate, which is slightly lower than the stock market's historical average annual return of 7% net of inflation. So about 8% gross, 6% real rate of return after adjusting for inflation. with an earnings per share of about $400 per share by 2030. And again, the expectations are 257 is what we have seen as of last week from all the companies that have reported earnings, 278 by 2025, and 313 by 2026. So if you come over to our analysis on the S&P 500 here, so this is the market temperature chart that I've shared with all of our members in the past. And this kind of gives us a little bit of an overview of where the markets are, right? So this is the S&P 500 valuation. That's what we call it. If you come down, you'll notice at 5307, obviously we are based on 2021, 2022, 2023 basis, really high multiples at over 27, 24, 24. Based on 2023, 225, we're looking at 23 and a half. And 2024, for the entire year at 247, we're looking at 21.5 times earnings multiple. 2025, 278, which is, I think, what they mentioned, 278, boom, there we go, $278 by 2025. We're trading at about a 19 times price to earnings multiple, which is about average for the S&P 500. So this is a market which is quite reasonable. I would say it's fair. Is it trading at maybe a slightly higher multiple or technically overbought conditions? Yes. But it is still not a market where I would go heavily dollar cost averaging or heavily shopping into this market, because it's trading at near fair valuations, or maybe one could argue slightly higher than its fair valuations. So trading at a little bit of a premium. And what we want is discounts and deals. And discounts and deals don't come to us at fair value or slightly higher than fair value. They come to us when they are at discounts and deals. And the last big buying opportunity for us was back on April 20th. And the MoneyVest Index kind of tracks that very closely, taking into account 4 or 5 different multiples and metrics and a combination of a lot of different metrics. So that's all I've got for you today. FOMC, again, changing a little bit of that tone, which I think is very interesting. So let me know your thoughts down in the comment section below. And what do you think about these expectations for 2030 S&P 500, the Dow Jones, providing us with another 40-50% gain? That's about 67% on average compounded every year. So let me know your thoughts down in the comment section below. As always, make sure that you drop a like, subscribe to the channel. Links to our Discord and Patreon is going to be down below if you're interested in joining us. We'd love to have you on board. 16% annual discount available until the end of this month. So always happy investing. I'll see you all in the next video.